Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this first session of the year for the LONGWave video, we will talk about the major investment themes for 2024. We show here the macro themes for 2024 at the bottom and last year's 2023 at the top. In our recently released Under the Lens video, we discussed these 2024 macro themes. Here I'm showing the 2024 macro themes and how they align with this year's investment themes shown to the right of the vertical red line. We won't discuss the individual sectors and instruments in detail in this session, but will instead try to position them, highlight what is important, and draw some conclusions for timing in 2024. It is actually the purpose of our weekly newsletters to focus on these individual sectors and instruments as 2024 unfolds, as well as within the other areas of the Matasi website, the other areas being the triggers and strategic investment insight sections. Besides the Under the Lens video I mentioned, in arriving at these investment themes, we refer you to the November and December LONGWave videos, which were foundational at arriving at these investment themes, along with the February Under the Lens macro themes video. In this session, I'd like to position these investment themes in the context of the subjects listed here. I want to start with the big picture. Seldom has the big picture been more important. Normally, the big picture is like watching paint dry or an iceberg melt. Interesting, but of little value in the short term, which financial markets operate within. This is not the case currently. The U.S. and world is in the midst of an incredible change, which I outlined in this year's thesis paper, The Regulatory State, where I compared it to 1849 and the beginnings of the shift of the imperial state to the democratic sovereign state. Vladimir Lenin said it aptly. There are decades where nothing happens, and then there are weeks where decades happen. We're in just such a time now, I believe. We're experiencing change that I've talked about throughout 2023 that includes a major change that is generational in nature, an adjustment to the world becoming a multipolar world, less dominated by U.S. policy and dictate, and the adjustment to the post-Great Moderation era. The importance of the end of the Great Moderation era is a shift in the three areas shown here. With what is called reshoring and de-risking, nations are rethinking globalization and supply chains. Globalization delivered labor arbitrages, cheap labor, and cheap commodities. That deflationary force is being replaced by potentially inflationary pressures. This is a secular change, not a cyclical change. Secondly, financialization is changing from what delivered steadily falling interests and funding rates since the 1980s to rising rates and the increasing cost of funding. The reason is rising risk premiums and duration bond premium, both associated with increased risk. Global conflict and financial complexity is increasing risk in many ways, including moral hazard and unintentional consequences. Thirdly, the world of mercantilism is changing, and by this we mean that the practice of emerging export nations by using their currency reserves and excess profits to buy U.S. bonds, which drive down U.S. interest rates and strengthen the U.S. dollar, allowing the U.S. to become an unprecedented, indebted 70% consumption economy. Additionally, this fostered export nations using currency devaluations as competitive advantage against the G7 developed nations. These changes are profound and are creating major adjustments and trends that impact your investment themes. Last year in this session, we showed this big picture market expectation. Shown in red in the top right corner, you can see we were looking for a possible double top in 2023, which we got. With this complete, we expected a major consolidation to begin, which we envisioned as a lost decade, or what we referred to as the beta drought decade, which would be marked by stagnation, stagflation, and global debt financing problems. We still feel that is in the cards. This chart highlights the dome top we believe we're currently in the process of putting in. This sort of top takes a long time to put in and should be described as generational in nature. The investment takeaway here is that it will not be a good decade for total real equity returns. By total, I mean dividends and capital gains will be poor, and by real, meaning in after inflation and currency devaluations. The shape of this market chart also aligns with other changes. It mirrors this chart of household net worth as a percentage of disposable income. We can expect the U.S. to experience a decade of reduced standards of living in the U.S. and developed nations. Reduced standards of living suggest tightening consumption levels and a reversing wealth effect. Both have been pillars of establishing the U.S. as a nearly 70% consumption economy. Elevated inflation driven by scarcity, poor public policy, and currency devaluations will highly likely be with us for the duration of the decade. Developments here will have profound impact on your choice of investment themes. We laid out this roadmap in our 2023 thesis paper entitled The Great Stagflation, which continues to unfold as predicted. We are now at a critical inflection point as shown in this chart, which we also featured last year. The Dow Jones Industrial Gold Ratio has clearly identified previous periods of protracted cyclical stagnation and stagflation. Last year, we had just completed the D leg of a predicted final ABCDE consolidation before breaking out. The E wave, a circled E, has ended at precisely our predicted cusp, identified by two diverging red arrows. We believe we are headed down. However, the wild card here is yet to be dealt. We will talk about that more in a moment when we talk about the regulatory state, regulatory repression, and monetary and fiscal policy. The continuing shrinkage of market breadth is a serious risk. The degree to which the Magnificent Seven now dominate the equity markets is a harbinger of what has historically happened when this occurs. The Nifty 50s of the 1960s-70s and the dot-com bubble of the late 1990s should not be ignored. These periods do not end well and lead to protracted periods of financial underperformance of equities. A dot-com-like crash may not be imminent, but the current preoccupation of the potential of AI may, like the dot-com bubble and the advent of the internet, evolve differently than everyone believes. There is little doubt it will happen and will be big. However, don't confuse the adoption with how the markets will adjust the pricing of this new evolving technology. We learned that with the dot-com bubble bursting. Our financial markets are increasingly coming under control of financial regulators, government edicts, and the vast global derivatives trading game. The equity markets are the tail on the dog to what is going on in the derivatives market. The derivative complex is involved in all aspects of the financial markets with an array of complex products that have become impossible to regulate globally in any meaningful fashion. Simply said, it is an accident waiting to happen that will stem from increasing volatility, from rising global risks, which will have unknowable and unintended consequences. The 2023 UK derivative crisis as a result of liability-driven investment funds were at the center of this severe stress that emerged in the UK gilt market in the aftermath of the September 2022 UK mini-budget. It is but one example. The COVID-19 financial shock of massive deficit spending and growth on government debt has yet to be fully felt. U.S. debt to GDP is well above Reinhardt and Rogoff's 90% no-return threshold, and once broken has gone almost parabolic in growth. It doesn't matter who is running the administration. The game is uncontrolled spending, because it is actually the only way now to keep the system from imploding. This happens when it takes $1.55 in budget deficit to generate $1 of growth, or $2.50 in new debt to generate $1 of GDP growth. We are simply trapped by decades of bad monetary, fiscal, and public policy. But it isn't just a U.S. problem. Global debt is hitting new record highs every day. It hit $224 trillion in Q4 2023, up from $150 trillion in 2013, which in turn doubled from the $75 trillion in 2003. In the past 10 years, government debt has grown by 60% to $83 trillion, corporate debt 50% to $86 trillion, and household debt 40% to $55 trillion. There's a limit to this. It has to be funded. Where is the collateral to support the lending going to come from and be created? because it's real wealth that has to be created to create collateral. Debt above Reinhardt and Rogoff's 90% of GDP slowly begins to cause problems on multiple fronts. Not only does it begin crowding out new investment in productive assets, but it increases credit default costs that increase very rapidly in a geometrical fashion, which directly carries over into debt costs, as shown here, where credit default swap rates track the increasing yield required to sell government longer-term duration bonds. Corporate spreads then begin to widen, and on and on. The normal warning signs in the U.S. are becoming somewhat dampened currently by government economic reporting using statistical distortions and stealth liquidity pumping. I've written extensively about this in our weekly newsletters as Stage 1 quietly drained reverse repos from nearly $2.7 trillion to the approximate $400 billion level today to finance government debt. Stage 2, using nearly $60 billion in BTLP rate arbitrage, is currently allowing highly leveraged hedge funds to increase funding from just short-term T-bills to longer-term duration government debt. These are short-term gains that cannot be sustained and will require further significant increases in the Federal Reserve balance sheet and various regulatory repression methods, such as off-balance sheet contingent liability guarantees, yield curve control, QQE, and new ideas never before been used. None of these are solutions, but attempts to defer what appears to be inevitable without wholesale changes to the global financial system. During 2024, monetary and fiscal policy will be acutely watched and reacted on by the financial markets. The Federal Reserve's long-awaited pivot to reducing the Fed funds rate will occur in 2024, later than the expected March timeframe, and likely driven by a financial crisis in regional banks or commercial real estate or a geopolitical event shock. Whatever the event, it should be expected, and your portfolio had better be able to handle it. The Federal Reserve historically always follows. It seldom ever leads. In a stable environment, it follows the 2-year Treasury note, which the money center banks tightly control. Remembering it is the money central banks that sit on the boards of all the regional Federal Reserve banks. It is presently sending a message to the FOMC, that is the 2-year note shown here in orange, that it is time for the Fed to lower rates. The Fed can be expected to likely take action before June, barring a crisis event, which would make it happen sooner. When we consider the 2-year yield minus the Fed funds rate, we can see we are clearly in the historical danger area. The Fed is attempting to buy as much time as possible to let inflation fall further, while at the same time allowing the Fed and Treasury to force real rates higher through increased Treasury tip issuances from the U.S. Treasury. The problem here is that though the real Fed funds rate is already at levels that have crashed markets previously, the 10-year rate is not yet near the 2.5% area that has crashed markets in the past. This is where tip issuances through the U.S. Treasury auction are hoped to help in Q1 and Q2, all intended to give the Fed and Treasury more room to fight the inevitable, they hope, after the coming U.S. election, or leave the mess for the new administration. This Matasi proprietary chart we publish regularly in our weekly newsletter shows the correlation of the yield curve steepening and when markets actually start to react. We see this clearly when we compare the current situation to the dot-com bubble and the 2008 financial crisis. Indications are that it is still out towards Q3, but of course this can and is likely to change. There is little doubt 2024 is going to be an interesting year, especially when we see the degree to which global central banks have begun accumulating gold reserves. This is no coincidence. It tells you what those who are expected to know think lies ahead, or at least they themselves are thinking. It may be 2024, but it is brewing, and your portfolio must be weatherproofed accordingly. So what can we conclude? Our weekly newsletter and chart package will focus on the investment products that match the current situation analysis we just discussed and our macro themes. We don't give investment advice at Matasi.com, but with the aid of a professional financial advisor, we think you will be better prepared for what it folds. The U.S. equity risk premium using the 3-month T-bill is at a 23-year low. This is quite worrying, especially in light of everything we have just described. When I look at the Magnificent Seven and how Meta and Nvidia just performed, I feel investors' exuberance is overextended. How Wall Street can reward sectors that are cutting jobs without damaging consumer spending is a puzzle. We wonder if stocks are disconnected from Main Street, like Meta, who has reduced headcount by 20,000, bought $20 billion in stocks in 2023 to the tune of $1 million in buybacks for every fired employee. Like Nvidia, though I believe the future of AI and the future of leaders such as Nvidia, I can't help but wonder how a 70% consumption economy sustains itself when the inevitable layoffs will surely begin to arrive. I'll leave you with one final thought. The Exeter Pyramid serves as a guide to comprehend the risks facing America, particularly in anticipation of what may be the most severe credit crisis in the coming decade or two, centered on the U.S. debt crisis. Organized from the most illiquid and highest counterparty risk assets to the least risky and most liquid, the layers of the inverted pyramid provide a unique perspective that builds from the mindset of a counterparty risk-sensitive investor. A swift glance at the pyramid reveals that the removal of any assets on the lower end, the more narrow base, will lead to the downfall of everything associated with it on the higher end, akin to a collapsing Jenga tower. This is why any problems in U.S. debt, and with it specifically U.S. Treasury bonds, as the global risk-free measure, along with the U.S. dollar as the global reserve currency, are potentially so devastating. This model also unveils the inflow of capital during economic phases. In times of credit expansion, capital ascends the inverse pyramid into higher risk, lower liquidity assets. This occurs when investors see systemic economic safety and are comfortable taking on greater risk for higher returns. Note the broadening of the pyramid signifies the reusing of the same capital as collateral multiple times, that is, fractional reserve banking and margin lending, contributing to an exponential amount of theoretically contracted capital found on the highest layers. This may sound astonishing, but the widely held belief is that the value of assets trading in the white layer, derivative layer, reaches into the quadrillions. In a crisis, deflation is observed as credit flows down the pyramid towards the higher liquidity, lower risk assets like bonds, cash, and gold. This occurs as capital is recalled and flows back to more stable ground, illustrating the waterfall of credit returning to the bedrock of the financial system. Risk-off assets with minimal counterparty risk. Depending on the severity of the financial crisis, one may actually see a greater allocation in yellow layer assets rather than the base layer of gold. Interestingly, this in part explains why treasuries tend to do better than gold initially on the onset of a crisis, depending on the type of crisis, of course. The insight here is that there are layers of risk often unseen or incomprehensible to many. John Exeter's inverted pyramid provides a contextual view of capital and credit flows during macroeconomic expansions and contractions. When considering potential investments or business opportunities, there's more at stake than just examining a balance sheet. Unfortunately, our financial system is inherently flawed, relying on credit notes we designate as money. The foundation is compromised, yet the entire global financial structure is built upon it, creating frustration on various fronts. Business operators can't solely focus on being savvy investors and ignore the interventions of central planners. Similarly, savers cannot accumulate capital with the expectations of passing it down without being significantly impacted by decisions made by figures like Jerome Powell. The silver lining, however, lies in an alternative, John Exeter's foundation base layer of gold. That means individuals are not bound by the uncertainties of government central planning. Any personal capital stored in gold enjoys liberation from credit risk, bank failures, currency devaluation, and much more. But I need to stress, it today comes with the fact that the government is predatory in taxation, and capital gains on gold you can expect to be called windfalls and taxed highly. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take that money or it is of simply no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty
how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currency, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there's actually seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading. Make sure you have a knowledgeable and well-informed financial advisor. I sincerely thank you for listening.